Hello, hello, Central Texas, and this is Bill Vernon, your Keller Williams agent for the Central Texas area, and we are doing the I-35 Realty Show, and I really appreciate everybody coming and listening. We got Aaron on the boards. We really appreciate Aaron's participation in this, and we got a great guest that's coming up. We got Thomas Baird. He's going to come back and give us, and I warned you guys all this last Saturday. We're going to bring Thomas on, and he's going to show us how to become wealthy. And I really, when I'm talking to people, I always go, who do you know that I need to know that needs to buy, sell, or invest? So this is part of our investment part of our credo there of asking great people to come on here and tell us how to invest in real estate, how to be profitable in real estate. And we had Thomas Baird, real estate attorney extraordinaire from Temple, Texas, come and talk to us about IRAs the other day, and now we're going to talk to him about something that is really a great way for us to build wealth, and we're going to talk about the 1031 exchange. And so let's bring on Thomas right now. How you doing, Mr. Baird? You doing well today?
I'm doing wonderful. Thanks for letting me be on the show.
Oh, hey, I appreciate you taking time out and coming here and talking to us on a Saturday. Of course, everybody can reach out and talk to me at 888-559-5217 or visit us on i35realty.com or see us on, and you can hear Thomas Baird. We're going to have this show, and we're going to have previous shows for you to listen and go back to because this is a pretty deep subject. Thomas and I were talking earlier about how deep this is, and so we're just going to dive into the deep end of the pool with Thomas. Thomas, what is the origins and what is a 1031 exchange?
Well, 1031 exchange refers to a section of the Internal Revenue Code, and it's a section that was passed by Congress, and then subsequent to that, the IRS developed rules and regulations concerning an exchange, what's sometimes referred to as a like-kind exchange. Where you transfer property for like, and many things though, like you can exchange cows for cows, but you can't exchange cows for bulls because they're not like. One's a male, one's a female, and so you can exchange personal property. You can exchange a bulldozer for a bulldozer, but you can't exchange a bulldozer for a front-end loader. I mean, they're not like type of equipment. So exchanges can be done with personal property and with livestock, but in many cases you don't see them very often because it's very difficult to get like for like. But in real estate, there has been adopted a very broad definition of like-kind property, and you can exchange a rent house or an apartment complex or for a self-storage facility or for raw land or a ranch or oil and gas minerals or royalties and an office building or just anything that is sometimes even water rights. They're all classified as real property, and that's because of our historical definition of what constitutes real property going back several hundred years. And so because of that, most of the like-kind exchanges that take place are real estate like-kind exchanges. You can't exchange a partnership for partnership for stock, or an interest in an entity. Those are not like kind, and therefore you can't do it. That's why most all the exchanges that you see are always going to be in real estate. And so with that broad definition of what that is. So that's what a 1031 is.
Okay, and why would I want to do this?
Well, if you have property that you bought 30 years ago, and you paid $100 an acre, and actually I've seen that sort of thing, or $200 an acre, and that land is now worth $10,000 an acre, or maybe it's going by $3 a foot. So it's $120,000 or $30,000 an acre, and so your basis is very, very low, and so your tax, capital gains tax, is the selling price, unless your basis. That difference is what's taxed on capital gains. Capital gains rates are now 15 to 20%. Plus, we have the once you get above a couple $100,000, you also get stuck with a 3.8% affordable health care tax for investment income. So often I tell people just figure on 23.8% capital gains tax on your property. And, people don't like paying taxes. And if you're going to turn around, and many people, when they sell a piece of real estate, they don't want to invest in the stock market or put it in a CD in the bank and get 0.025% interest rate. They want to buy other real estate. Or they want to buy a ranch, or they want to buy something income-producing property that will give them some cash flow. And so if you could sell your old property and not pay any tax and invest all those proceeds in one or more new properties, then that's a great deal. So if you sold something for $1 million and you bought $1 million, and it was non-productive land, and you bought $1 million of investment property that paid a 10% return, you now have $1 million piece of property and you're getting $100,000 a year in income. A pretty slick way to get some cash flow.
Right, and theoretically, we might have a single family, a rent house, and we could take the capital gains, move it into a duplex, and then move that duplex into an apartment complex, move that apartment complex into a shopping mall, and pass away at some point, and our kids would be at that basis, and yet we've protected ourselves from the tax liability.
Well, your tax liability, and if you whatever property you die with when you die, you get a step up in basis, so your kids can now sell it and pay no tax. So if you live long enough and you're smart and you're astute, I should say, in how you invest your proceeds from the exchange into new properties, and you're willing to hold the property and produce an income stream for your lifetime, then if one spouse dies, then the other spouse can sell it, or wait till both spouses pass and then the kids inherit it. And one of the unique things under the estate tax code is that when you die with property, you get a step up in basis to fair market value as of date of death. So you might have bought something for $100, and that is now, $10,000 an acre that you sell into something that's now worth, something much more than that. But your original basis, it keeps carrying forward, is at $100 an acre. But if you die and that land is now worth, mega millions, you get a step up in basis and no capital gains tax. Pretty slick thing. A lot of people come to me, especially if they're older, and one of the things I say, I need to sell this. I said, why? Well, because I just want my kids to deal with it. Well, you want to sell it now and pay 23.8% in tax, or you just die with it, that's kind of cold-blooded, and then let your kids inherit it, and they have to deal with selling it, but they don't pay 23.8% tax on the value of the property. Do you think that they might mess a little bit of messing with it to save 25% of the value of the property? And they go, oh, of course. They say, well, you're not doing your kids a favor by selling it before you die. You're better off hanging on to it till you die.
Yeah, I see this situation happen a lot in the ranching world. Dad or mom are now older, and the kids really don't want the ranching property, so they could sell the ranch and mom and move into town and take that and buy some other property and avoid exactly that, giving it to the IRS to do whatever they want to do.
Well, so they could sell the ranch. Let's say they bought a ranch for $100,000. It's now worth $1 million. And they want to move to town, so they can sell the ranch and do a 1031 and buy investment property that produces $100,000 a year income, which is, I promise you, far more than that ranch ever produced. And then they can their basis is still low, but when they die, it's the step up in basis, and then the kids sell the new property or they can keep it, or they can sell it, and they pay no tax. It's a really slick way to avoid taxes if you think about ahead of time and the family has some strategy on what they're trying to do. Now, we're talking about people's lives, and that sounds a little cold-blooded, but, I have a lot of clients that say, if it's going to save that kind of tax, I'll just hang on to it.
Well,
or I'll sell it in exchange to something else and let them inherit that property, then they can sell it.
Again, you're saying it's cold-blooded. Of course, you're an attorney, so that's interesting that you're saying that.
But, well, I've been beat up so much about being a cold-blooded attorney. I maybe a little bit self-conscious.
Yeah, you're a little prickly about that. But in all seriousness, and I have no problem paying my taxes and paying my due. But I'd much rather see inherited wealth, and that's how family builds wealth. It is through, the Kennedys, pick somebody, the DuPonts. How do they build wealth? Well, they use things like this, and that's what we're talking about.
There's a famous court case by a judge named Learned Hand. Now, those people knew their son was going to be a judge, didn't they? Mm-hmm. Learned Hand, and he was a judge back in the teens, 20s, and 30s of the last century. And he's probably the most well-respected jurist that never sat on the Supreme Court, had many, many famous court cases. And one of his most famous one, he had a quote. In fact, I have it up on my wall. It says, "Anyone may so arrange his affairs that his taxes are as low as possible. He is not bound to choose a pattern that best pays the Treasury. And it's not even unpatriotic to do so."
Right, it isn't. Well, who are the parties involved in a 1031 exchange?
Well, there's a seller, and then there's a buyer. First, you got a contract, and one of the requirements in a 1031, you got to put in the contract that the seller wishes to participate or the buyer wishes to participate, because sometimes the buyer is using 1031s to buy it, or the seller wants to take his money and use those to do a 1031. So you put that in the contract. It's about a paragraph, real simple. And you go to the title company, and it gets processed, and you got to select a 1031 company. And there's several of them out there. One that I'm affiliated with and work with quite a bit is called Unlimited Exchange. And so Unlimited Exchange will act as qualified intermediary, and I'll prepare documents on behalf of Unlimited Exchange to go to the closing table, and all the parties sign the exchange documents. And what happens is when you sign those exchange documents, the seller cannot take actual or constructive receipt of the check. You can't even have a check made in your name.
Well, let's slow down for just one second.
Okay.
Define what a qualified intermediary is.
Well, qualified intermediary is somebody who's not the seller's agent or fiduciary, and so or someone under their control, like an employee or whatnot. So it could be, it can't be somebody. It can't be your lawyer or your accountant. But usually it's just like a third party who's in the business of doing exchanges, and they are so. And typically, the exchange company will, like what Unlimited does, they will. Each exchange they set up as a separate account, a separate numbered account, and only your money goes into your account. It, of course, is in their name with a number. And, you can be given copies of the deposits and copies of the bank statements and copies of, every month, so that the money's there, not going anyplace. But the exchange company does that. Not every exchange company does it. Sometimes put it all in one pot. And I just see that as a recipe for disaster. Mm-hmm. So I like segregating the money and keeping it
right.
Uncontaminated with somebody else's money.
So to kind of, and to stop you for a sec, I want people to be very clear on this. Qualifying intermediary, we cannot have a relationship with this person. In other words, I have a relationship with Thomas Baird. He's done some partnerships with me and my trust, my wills, blah, 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 blah. I can't go to Thomas Baird and say, hey, will you hold the money for me? Because you and I have a relationship.
That's a fiduciary relationship. That's correct.
All right. So we have to go find somebody that really I don't know.
Well, and so you don't go name a stranger. That's why you have these companies that specialize and they do this. That's what they do. And actually, part of a lot of them are associated with a title company. It's just an ancillary company or brother-sister company with a title company, as Unlimited Exchange is. And the people at the title company also run the exchange company. They're just, so again, you got some people who are used to doing this. They understand it. They know the rules and that sort of thing.
Mm-hmm. Exactly. So it's, that's, again, getting with someone like you who can go, okay, this company here will be holding your money, and we know when we come back to buy the other property, it's going to be there with
It's still going to be there, and you can look at it. You can see. They can give you the statement, and you can see it's there. You just can't have any signature rights, and you can't go withdraw it at will. It's actually in the name of the intermediary and a fiduciary type relationship, just like a bank trust department or whatever. It's your money, but you can't have control over it. And so, but that's really, we can work people through that, and they can usually get pretty comfortable. But the exchange company actually signs the closing statement, or sometimes called the HUD-1 closing statement. And the money goes directly from the title company into the exchange company, the qualified intermediary, and they hold the money. And once the closing of that property that you're selling, or the relinquished property or selling property, then you've got 45 days from that date to designate your replacement property. That's a property you want to buy, and you can do 3 properties with no restrictions. If you do more than 3, you can do more than 3, but they begin to have restrictions, and so most people don't want to deal with all those restrictions, so they just usually name 1 to 3 properties. And you do that within 45 days. Now, if you know you're going to do an exchange and it takes a month or 2 or 3 to get the closing table, you can start looking 2 or 3 months ahead of time. So you really can have 3 or 4 months sometimes to buy or to designate your replacement property. But if you don't have it and you wait till the closing date, then you got 45 days to go find it. You don't have to put it under contract. You don't have to buy it within 45 days. You just have to designate it and sign on a little form. Yes, this is a property, or these are 3 properties I may want to buy. And you got to give some explanation about them and give some description and that sort of thing. And then you actually have 180 days from the date that you closed, when you sold the property, sold the relinquished property, 45 days, and then 180 days. Both dates originate from the closing of the first transaction. And the 180 days is to close on the property you designated within 45 days. And you can actually buy one property in a month, and another property 2 months later, another property 4 months later. I mean, all those are, as long as you stay within the 180 days, the 6 months, then you have no problem, and you can close. Now, if you don't close within that money, then with 180 days, then the exchange is busted. Whatever money's left goes back to you, and you pay tax on the money that you receive.
So you kind of answered another question I had. Let's pretend Bill had this problem. I'm selling a property; it's worth $12 million. I could go and invest the $6 million in the exchange scenario and pay tax on the other $6 million.
That is true. Now, what happens is the way that they figure the basis and so forth, the basis gets used up in the first property. Okay, and so that's your replacement property, and so the property that, if you use all the basis up on the property you're buying, then there's really no basis for the cash portion, the boot. It's just all taxable.
And you just used an interesting term there, boot. What's the definition of that?
A boot is I don't know. It's I've heard it all my life.
Yeah, I've always wondered where did they get that term?
Typically, it's just the cash that you get out of a transaction.
Right.
It's the little extra. So if you sold a property for $1,100,000 and you bought a replacement property for $1,050,000, then the boot would be $50,000. That's a little bit of cash left, the stub amount of money left over that wasn't used. Now, you can buy, if you sold a property for $1.1 million, you could go buy a $2 million property, and there is no boot because you used all $1,100,000. And another thing to remember is that when you're doing an exchange, if you have debt on the property, when you do the exchange, to totally avoid paying any taxes, you've got to, when you buy the replacement property, you've got to have equal or greater debt and equal and greater equity. So if you had $1 million, you have a $2 million property with $1 million debt, you've got to go buy another property or properties totaling with it, they had a total of $1 million debt and have $1 million equity. And if you don't, either less debt or less equity, that will be boot. Now, maybe you didn't get any cash, but if you bought a property, if you had a $2 million property, had $1 million debt, and you bought another property for $1.5 million, and you put $1 million equity into it and a $500,000 debt, you have $500,000 less debt. That's that decrease in the debt from the first transaction to the second transaction is also considered to be boot. It's like you got cash. You have $500,000 less debt. Therefore, that's going to be taxed as income to you.
Right. Okay. And a little more about boot. If we were, let's go back to our ranch example. If we during the deal we're also selling, I guess, what irrigation or equipment or tractors or stuff like that, we would not be in a likes.
Well, there's a little leeway if it's incidental to the transaction.
Okay.
If it's incidental transaction, 1, 2, 3%, like an apartment complex, and you got stoves and refrigerators and dishwashers and washers and dryers, but that's incidental to the transaction, then they're not going to worry about that.
Okay.
If you're doing your farm deal where you got tractors and combines and hay balers and pickups, okay, then and let's say you got $300,000, $400,000, $500,000 worth of farming equipment. Okay, that's not incidental. And if it's just a rule of thumb, if you're above 2-3% of the overall value of the property you're selling is in personal items, then those items are probably not going to be considered part of the exchange. And those items, the money you get for that will be a sale. And what's doubly bad about that equipment, a lot of times it's depreciated down to almost nothing. And so therefore, you often, because you've depreciated, you get recapture of that depreciation if you've taken it down too quickly. And so a lot of times that's ordinary income, so it's at a higher tax rate. So a lot of times people really argue and fuss about what the personal property is and how it should be valued and whether that should be part of the exchange or not.
Well, we have Thomas Baer on the line talking to us today about 1031 exchange, and we got actually a lot done in this time, and I really appreciate Thomas. Thomas, how can we reach out to you if the listeners need to talk to you? Because again, I want everybody to understand that Thomas and I are doing this in general. We're not talking to you specifically. I know you're listening to us specifically, but we need you to get in front of Thomas and make sure we do this right. How can they get a hold of you, sir?
The best way to reach me is on my direct line at my office, 254-743-7310, 254-743-7310, or they can email me at Thomas Baird, all run together, small letters, ThomasBaird, my name, at bcswlaw.com. That's initials of law firm, Baird, Cruz, Schiller, Whitaker, and so bcswlaw.com. And they could email me or give me a call, and I would try to answer the question or point them in the right direction.
Well, Thomas, we really appreciate you showing up on the show. And again, folks, we love you listening to us. Give us a call. You can reach out to me at www.i35realty.com. Of course, you can also get on the phone, 888-559-5217. You can listen to Thomas. We talked about a lot here. If you want to re-listen to this, we'll have it up on the YouTube, I35 Realty in there. Run that all together. Don't forget your slash. And you can check out and listen to Thomas's previous appearance. And we look forward to seeing everybody and talking to you about real estate again in the Central Texas area next Saturday. And again, give us a call if you know anyone that needs to buy, sell, or invest in real estate. We'll see you next Saturday.